Hi, everyone. This is Jason Beck of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. She's a former investment banker specializing in technology companies, also a 3 times best-selling author. Her first book, and I highly recommend going out and reading it if you desire to ever be an entrepreneur, is The Entrepreneur Equation, Evaluating the Realities, Risks, and Rewards of Having Your Own Business. It's the most balanced entrepreneur book I've ever read, and I've read dozens of them. Her second book, which came out around the pandemic, was The War on Small Business, How the Government Used the Pandemic to Break the Backbone of America. And her most recent book is You Will Own Nothing, Your War with a New Financial World Order and How to Fight Back. Carol Roth, thank you for joining me again.
Yes, glad to be back with you, Jason.
So, Carol, we're recording this interview on Friday, May 31st, 2024. You just recently testified before Congress about small business. So how would you classify or grade the current state of small business in the United States?
Oh, small businesses are getting absolutely crushed. I'll start with my testimony. So I went in front of the House Small Business Committee at the end of April, and this was to testify against something called the Corporate Transparency Act's Beneficial Ownership Information Rule, or CTA-BOI rule. A big mouthful to basically say they want to take and put together a database of all the small business owners and all the people who play a quote unquote important role in small business, whatever that means. And that database is being run by FinCEN, which is the Financial Crimes Enforcement Network, which is the Financial Crimes Division of the Treasury. So this is an absolutely insane proposal. The stated reason is that they want to combat money laundering and terrorist activity and cartels. And I'm very sure that all of the money launderers and terrorists and cartels are going to register with the Financial Crimes Enforcement Network. And it seems like a really good idea. So it's just totally ridiculous. And what I did is I brought with me statements from about 450 small business owners and people who are wannabe entrepreneurs as well. And what was interesting is not only in their statements did they talk about the fact that they were incredibly against the CTA-BOI rule, but these small business owners from all over the country and all different kinds of businesses talked about how hard it is to be a small business. And on top of that, I recently reached out to my own small business community. So there are sort of 4 areas where they're really, really hurting. And none of these will probably be a surprise to you, although maybe the last one will. The first is government. Government is putting up all kinds of barriers, lots of bureaucracy, just making it very, very challenging to be a small business. Anti-contractor rules, the Department of Labor rule, local governments not listing, just up and down. It's tough for small business. Inflationary impacts are very obvious. Obviously, that's hitting the middle class and small business. The costs are increasing for everything, and they're having a harder time passing those costs on to the consumer. So that's a challenge. Labor, which is a holdover issue from the COVID mandates and their after effects, while it's improved a little bit since then, it's still hard for small businesses to find, to hire, and to retain qualified personnel. And then the last part that the small businesses really have identified as a challenge for them is the digital landscape. In addition to cybersecurity threats and adapting to new technology, there is a lot of concern over AI taking over their intellectual property and their domain. So that was kind of probably the most interesting one. The others are fairly center of the plate, but small businesses have just been getting crushed since the COVID mandates in particular, and it's just been one thing after another for them.
Yeah, you mentioned a bunch of the factors. I had questions on all those. So it sounds like small business owners and the consumer are being grinded between like 2 main milestones now, with the Fed raising interest rates. So that's one of them. And then the other one is stagflation and shrinkflation on the other side. Those are kind of the 2 main ones. But then you add in more rules, regulations, red tape, and then potentially this new one, what you said during when you were testifying before Congress, it just sounds like kind of layering on more compliance, similar to what the banking industry went through with anti-money laundering and knowing your customer. How the large banks, it's fine because they can just hire more compliance people and they could just amortize that cost over a bunch of customers. But for a small business, that's really it absolutely hurts the profit margins and the overhead.
It's a really good point. And I think we did see this, coming out of the 2007, 2008 Great Recession financial crisis, when you saw the Dodd-Frank rules, who were the ones who really suffered from that? And it ended up being not the big banks that had perpetrated all these issues and caused all the havoc for Americans and created, frankly, financial issues globally. But it was really the small businesses. And so after those rules and laws went into place, you saw fewer small businesses, or excuse me, small lenders being formed, small banks being formed, for fewer community banks, lots of them going out of business, a lot of them getting consolidated. And so there was less small business lending because the big companies obviously spend their time lending to big businesses, and the small businesses rely more heavily on community banks and smaller banks. So it really has been just one thing after another. And the big companies, they love this regulation. As you said, they can amortize it, they can absorb it, they have the scale to be able to deal with it. But for a small business, they don't, which is why sometimes when you see regulation, you might see a small business exemption that if you're not, as of a certain size, you don't have to participate. In this particular case with the CTA BOI rule, the crazy thing is that the big businesses were the ones that were exempt. So it really was clearly focused directly on the small business owners of this country. And to reiterate, sometimes we talk about small business and people think, oh, well, that's kind of a small thing. It's not. It's more than 33 million entities. If you want to expand to independent contractors and gig workers as well, there's about 70 million of those. The small businesses, they're about half of the private sector GDP and almost half of the jobs, and they create sort of the majority of the job growth in recent history. So from the standpoint of the economy, there is a reason why it's called the backbone of the economy. That's not just lip service. The numbers support that. And so to see them continuing to get crushed and seeing more consolidation and more power going over to the big businesses is really frustrating. And I think very analogous to things that you and I talk about offline, with this consolidation of wealth and power with the elite and wealth connected, and those people who are middle and working class Americans getting crushed. So the same thing that's playing out with individuals is playing out with businesses. And we're just saying those who are in the inner circle doing better, and those who are outside of the circle really struggling.
I think the average person on Main Street might not be aware of this unless they pay attention to the stock market all the time and quarterly earnings like you and I do. But when a large company actually starts like shutting down unprofitable businesses or closing locations or cutting expenses and overhead enormously, the stock price goes up. But that actually means in the real economy, a lot of people are out of a job. They might have to find a couple part-time jobs or a lower paying full-time job and then a part-time job to try to make ends meet. It's exactly like you said, the main engine of growth for our economy are the entrepreneurs and the small businesses that are actually investing and making new products and services. And so like the stock market doesn't always reflect this.
Well, that's very well said. And I say this over and over again. Wall Street is not Main Street. The stock market is not the economy. It is a collection of the largest companies that are very different than most of the companies in this country. When I tell you that more than $33 million small businesses, or excuse me, more than 33 million small businesses in the U.S., on the flip side, big businesses, there's only about 21,000. So the scale there, the differential is insane. 99.9% of all the entities are small businesses. And in addition, to providing sort of the economic argument that you made, there's a freedom argument too. Small business allows people to work flexibly, to have more of a say on how they earn a living, to not have to report to a traditional boss. They still have lots of bosses and their customers and whatnot that they have to report to, certainly. But, it does create an opportunity to work more freely and independently. And of course, we can't have that in this country. That would be a tragedy. So government and big business is doing everything they can. And certainly the unions are weighing in heavily too, to create more barriers for small businesses to be successful, when frankly, it should be exactly the opposite.
So I want to ask you about like the lag effects and the accumulated pain of higher interest rates that the Fed has done. Now, I see a lot of talking heads talk about that these are normal interest rates, but there's a lot more debt in the economy at the consumer level, at the business level, at the government level. Would you say that Main Street has been hurt by these interest rate hikes from the Federal Reserve Bank, that small business has been disproportionately hurt compared to a lot of large companies?
It's funny. I don't blame the change in interest rates as much, other than the fact that, before they raised the interest rates, all of the zero interest rate policy that we had for almost 15 years, or near zero interest rate policy, that the small businesses didn't get a chance to participate in that. So or businesses who wanted to take on debt, as well as people, anybody who really had that need, I think pretty much had 15 years to finance. And the large businesses were really able, because they're, have more scale and more ability to absorb more capital on their bigger balance sheets, to take that and compete in a way that was unfair, because, this was done by mandate and by monetary policy, and small businesses really couldn't take the effect. Coming out of that, what we've seen is inflation. We've seen inflation in assets, which again, the big businesses participated in more than the small businesses. And then I think the inflation that's come out of that is really what is hurting the small businesses more than the interest rates. When I'm talking to small business owners, it's not like, hey, I could get a loan at X and, now I can only get a loan at Y. It's more of, I can't pass these costs on to my customers. I can't hire because I can't find people at the current wage levels that are qualified. The input costs for my business have gone up. So I think it's really more of the effects of that 15 years of monetary policy, Jason, than the last 2 years of monetary policy. And I'm sort of contrarian. I don't think the monetary policy is having much effect at all. People are like, oh, what happens if they cut? Like, do we really think that sitting at 5.25% for the Fed funds rate on the high end, if you went down to 4.5 or even 4.25, that's going to unleash all kinds of growth in the economy? I just don't see it. I don't think that that's the gating item or the gating issue. Certainly, if you took that back down to 1.5 or 2 or maybe 2.5%, but the 100 basis points, 75 basis point, 25 basis point different, is that going to impact the economy at this point? No. What is driving the issues are really the fiscal policy decisions, and that's what is keeping the inflation sticky in the economy, and what I think will continue to keep the inflation sticky in the economy, because this is not, in my opinion, one that's a situation that's dominated by monetary policy.
And you have accumulated inflation for years now since the pandemic. It wasn't just the US, it was all these other governments and central banks, many trillions of new currency units. And then the economy was not producing the amount of goods and services. So there was a lot of new currency units chasing fewer supply of goods. So that to me is a recipe for stagflation and shrinkflation.
Yeah, no, I think it makes a lot of sense. And I'm glad you bring up shrinkflation again, because, we hear from certain people this whole thing about corporate greed. And frankly, shrinkflation is just a downstream effect of inflation. When inflation takes hold and there are higher input costs, a business they're going to try to pass that on to their customers. And when the customers say, we have a certain amount that we're going to pay for a pizza or a candy bar or whatever goods and services, then they're saying, well, if they're only going to pay that much, we have to shrink the amount of inputs to go along to make sure that we're making the profit margin that makes our business sustainable and attracts investors and whatnot. So that's how the shrinkflation decision comes about. It's not just, oh, we're a greedy corporation, and just today we decided to be greedy. We've never been greedy before, and so we're going to shrink our products. It's really when there isn't the ability to pass along those prices anymore, that's when that becomes sort of their plan B. And so I think that not enough attention is really given to that, and becomes a one of these long-term issues that we have to deal with. And like you said, I do think that whether it is stagflation or shrinkflation or any of these, that this is long-term and sticky, because we have these deficits to GDP that the government's running that are more than double the historic average. And when you typically have a time period where the economy is quote unquote growing, you should see smaller deficits to GDP. But in this particular case, what they're doing is they're using those deficits to window dress the appearance of growth. And that's why everything is out of whack. And that's why fiscal policy, in my opinion, is starting to dominate the impact of monetary policy. And when you have the government moving in one direction, the Fed moving in a different direction, the Fed's tools just really aren't doing much of anything.
And I also think that the real economy, the consumers are more or less tapped out, or at least a lot of them are. There seems to be a real bifurcation in the real economy between the affluent who benefited from those low interest rates, like you were saying, for 15 years. Their assets got enormously inflated. And if they have cash now, that they can earn almost 5%, quote unquote, risk-free in short-term treasury bills. And then the rest of us on Main Street, I mean, with the stagflation, the shrinkflation, all this accumulated inflation, we have a lot less consumer discretionary income. A lot of consumers have tapped through their savings and their credit card debt balances with these high interest rates. It just means that a lot of consumer businesses, discretionary businesses, they're not going to get as many customers at a higher price point.
Yeah, I mean, and you're seeing the real effects of this play out when you look at, a Chipotle, or you're looking at, first class airline tickets. Those kinds of things are still doing well, but the value consumers, going to the value retailers, some of those are starting to have challenges. And it's for the reason that you said. I hate that we use averages. I'm a former investment banker, so you always use medians, at least in conjunction, if you're going to use an average, because when you have a society like ours, where a very small sector of the entire population has like ridiculous amounts of money, that is pulling up the averages, and it's really hiding and masking the effects that you're talking about, that we do have a tale of two economies. We have a handful of people, at the top who are doing really well, and, their assets on paper, at least, because, obviously it's not yours until you cash it out, but, their stocks and their homes, luxury real estate, a lot of these alternative assets have been inflated from the results of monetary policy. And they're reaping, the rewards, at least on paper, for that, while we're having the real impacts of those people who don't have a lot of assets, who are seeing the inflation and their everyday costs of living, the housing, whether that being trying to find a house to buy, or the cost of rent, the cost of food, the cost of energy. And it's just absolutely killing them. It's killing their savings. It's adding a ton of household debt. And, there's always, some jerk with a chart who's like, no, look at my chart, you're doing great. And it's really, really like anything else. Back to that Twain attributed quote, there's lies, there's damn lies, and there's statistics. And so you can kind of meld this to say whatever you want, but we know the struggles that people are having. They're telling people, they're showing that in the polling numbers for the upcoming election. And it's just really insulting when people are struggling to then sit around and not only not be empathetic to their struggle, but to tell them that they're lying or misinformed.
a good amount of the other guests, not you, because you go on Fox Business and CNBC a lot, but a lot of the other talking heads that go on Fox Business, I mean, like I've been saying for 12 months on financial Twitter that the real economy was clearly bifurcated in a lot of different ways. And I was getting like blocked and called names and insults for the last 12 months. Now here we are with the earnings calls with a lot of companies. I mean, you have Delta Airlines, which caters to what business class, and a lot of the other airlines are not doing well. We can go on and on with the different examples. A lot of the restaurants that were middle class sit down restaurants, I mean, they're closing locations like crazy. Red Lobster just filed for bankruptcy. Outback just closed like 40 or 50 locations. I could go on and on. These are examples that the real economy is bifurcated.
It's true. I mean, certainly in some of those situations, there are issues that are particular to the business, but I think the overall narrative is one that we've heard and seen, that people aren't able to go out to eat as often, and so they're making some very specific choices around that. And then we've seen the insane increase in the cost of everything from food to labor. If you go out to California, they had this ridiculous $20 minimum wage for fast food workers that begot the closing of lots of fast food locations. Go figure. We all knew that was going to happen. But what people don't understand is, even though it was just the quote unquote big guys that were targeted, which is never just the big guys, because if you were a franchisee that was a small guy associated with a parent company that's a big guy, you were impacted. But it's like the people who are instituting these things don't know anything about economics, or maybe they just don't care. But the reality is that if you have fast food places that are offering $20, that doesn't just impact those particular locations. It means if you are somebody that owns an independent restaurant, you are now competing with them for talent. So of course that impacts you, and it impacts the other industries as well. Like, why are you going to go work in healthcare or work in a job that's more challenging or physically demanding if you can go flip burgers for $20 an hour? And certainly, as good old Thomas Sowell said, the real minimum wage is zero. What it really does is it puts a lot of people, particularly young kids and people without skills, out of jobs, and doesn't give them that opportunity to enter the workforce. So it's there's a lot of unfortunate stupidity that's happened, and a lot of people who are decoupled from reality or think that there have been no consequences. And I think that's sort of the through line of all the things we've been talking about, Jason. If you think about zero interest rate policy, or you think about some of these specific mandates, it's all with the expectation that somehow the laws of you do something and then there's a reaction have been suspended, like that you're not going to have some kind of outcome, even if it takes a little bit longer to see. And when we had the zero interest rate policy, when we had the stimulus checks, when we have these policies, these are the logical outcomes that anybody with any sort of basic economic knowledge knows are going to happen. And then when they happen, a bunch of people stand there with the mouth agape going, I can't believe this happened.
So I want to transition now to single family homes. This is something you covered in your most recent book, You Will Own Nothing. Really, and you've talked about this in prior interviews with me and in other interviews, that since zero interest rate policy, Wall Street became very interested, and also pension funds and other institutional investors, in buying single family homes or multifamily, which are large apartment buildings, as kind of like an income product, I guess, since there was so little interest rates for US Treasury bills for so long, that they were looking for alternate sources of stable monthly income. Now with interest rates higher, are you surprised that institutional investors on Wall Street are still buying record amounts of single family homes? I think there was a Redfin report that came out for Q1 saying it was still record.
Yeah, so I'm not. The part that was interesting to me in doing all of this research is that before 2010, there was no meaningful institutional capital in the single family home market. And as you said, now we're seeing record participation in that market from corporations. And I'm not surprised, because there are only so many places you can deploy capital. And so once you kind of realize, oh, this is a place, and you open that up and it becomes acceptable to at least some group of people, I'm not surprised that they will continue to double down there. And I think, one of the quote unquote advantages corporate buyers have, in addition to having had 15 years of zero interest rate policy and lots of cash lying around that they got at lower interest rates, and probably still have some to deploy, is that, when they go in, they can buy up a whole neighborhood. They can buy a home without doing an inspection or a walkthrough. So, if you're a real estate agent and you have, a short-term point of view and you're trying to maximize your cash, you're going to find a way to try to deal with these corporate buyers. But what they're doing is they're putting themselves out of business, because once that home goes into corporate buyer inventory and becomes a rental, the likelihood that that's going back into being sold, from these institutional investors in particular, back to a family, are next to zero. So that means as they take over more and more of the market, that over time, there's going to be no inventory for these real estate agents to sell. So I think that's really silly. And if you're a real estate agent or you're an individual, consider not selling your house to a big institutional investor. If you've got some other competitive buyers, I know it's a little bit more of a pain to have someone do the walkthrough, but we want to preserve these opportunities, for households and for individuals to have an asset that, typically is the largest asset on household balance sheets. And the way they create their legacy wealth, we want to be able to preserve that. Now, one thing I will mention is that some people get the statistics on this wrong. I've seen RFK get this wrong. It's not that they, by 2030 are going to own 40% of all single family homes. It's 40% of all the homes that are sold they will potentially buy. By that, that's the sort of the trajectory that we're on, which is still, again, a bad thing, because there's only so much inventory that turns over every year. But I think it's important, if we're going to discuss the fact that this is an issue, that people at least have the information and the facts correct.
Is Wall Street and the institutional investors, the pension funds, are they using mortgages? Are they using debt? Because like the average person now with mortgage rates where they are, I mean, if they're buying a single family home or even a nice luxury condo in a major city or metro area, I mean, you're looking at $6,000 or more in a mortgage payment.
No, they're not doing mortgages. They're paying either 100% cash, which has happened for a long time. Because remember, they during 15 years were stocking up on this low cash, so they had all of this on their balance sheets. So they're using their balance sheets to be able to do this, and or using institutional capital, depending on how they're structured. That could be some combination of equity and debt capital in order to do that. So that this is not them going out and applying for a mortgage. So they're getting they're looking at things from a different perspective.
So do you think that this looks, is it developing into kind of a permanent renter class, similar to how like serfdom or feudalism developed?
That's certainly my concern. And I think that the pitch to individuals, in particular to young people who have been groomed to not own things, right? That they're heavily invested in technology, and they don't have a lot of ownership. I think they're groomed to say, maybe you can find something that you buy, but if you rent for the same amount as your mortgage payment, you can live in this wonderful condo, and we have a doorman for you, and we have a gym, and we have a pool, and we have a rec room, and you can do all these things. And someone goes, oh, great, look at all these amenities I could get. My life will be so much more fun. And they don't realize that not only by making that shift, they're giving up their wealth creation opportunity, but they're giving up their freedom, because, having ownership, having property equals freedom. And if you are living under a place that somebody else owns, it's not yours. And, you have to abide by their rules. So I do think there is this, sort of glossy paint. And this is, if you go look at the filings, the annual reports and the 10Ks and the like of any of these institutional investors that focus on this, they'll talk about how they go after the middle class and how it's so easy and it's a carefree lifestyle. And they're trying to rent the American dream back to other people. So I think there is this desire to capture that wealth, in and among the institutional class, and to create renters. And they're trying to sell people on that it's easier and more carefree, and you can get more for your money. but you don't own it. So that's the challenge. And then, of course, there's the other issue, which is that property taxes and insurance are getting so crazy that that is also pricing people out of ownership. Although theoretically, these investors are still having to deal with that and put that into the rental prices. But I've heard just so many horror stories of one that I include in the book, and other people I've talked to who've just seen their property tax bills, triple and quadruple, and they're just paying these insane amounts. And most of that in a lot of cases are going to school townships to pay administrators. And in some cases in townships where the kids come out and they can't even read or do math. So it's a very frustrating situation. And again, all of these barriers that are keeping people from participating in the American dream and keeping them from that wealth creation and ownership.
It sounds like permanent rent increases. I don't know if you've seen the chart on the St. Louis Fed website. It's one of the few honest government statistics they have on the St. Louis Fed website. And it shows like the rent, it tracks like rent for first time for people in their primary residence in urban areas since the 1950s. And it's parabolic along with like wholesale food prices.
Yeah, no, it's I think that's one that you've been kind enough to share with me. And yeah, it's crazy to watch all of this.
So basically, it seems like a lot of the people benefit. Do you think the people like who are implementing these policies, are they evil, or do they just like the status quo? And so people are going to have to adapt to it.
I get a lot of crap for saying this, but in some ways I don't care. I care about the outcomes, whether they're malevolent or clueless. We still have to deal with it, and I kind of view those as two sides of the same coin. I think that whenever you have a situation that allows individuals to have that level of power and to make these decisions where they're not bearing the risk, that they have the moral hazard sort of issue, and they also don't have accountability, and that we're not doing enough to really think about protecting individual rights, that you're just going to naturally have this as part of human nature. So some of it may be evil, some of it may just be a greedy personal power grab. But that's why the country was structured the way it was. And unfortunately, we haven't had enough people fighting back over time as things have gotten away from sort of those foundational principles. So that's kind of where I come out on it.
Yeah, I agree. A lot of people are complacent and they just don't understand how much their currency is being debased. So yeah, there's direct taxation from different politicians and at the state and local level, property taxes, like you said, if you buy a house. But there's also been a ton of currency debasement. And so like basically, unless you're working really hard to be entrepreneurial and come up with like a side hustle or develop that into a business to grow your income, your standard of living is going to suffer with the current status quo and the current policies by governments and central banks.
100%, and it's just going to continue to get worse. There's everything structurally that's pointing to the continued degradation of this path that we're on, and there's no clear will to make any of the hard decisions that would need to be made to change that path.
Okay, last question here, since I know you have a time constraint. The small business surveys are the worst in 12 years. Which industries, online or bricks and mortar businesses, do you think have a long-term bull market potential? What skills or business industries should people be looking at if they're looking for a side hustle or to be a successful entrepreneur going forward?
So this is going to sound like a weird way to slice this sandwich, so to speak. But anything that services the wealthy is a good place to be, because as we started this conversation, what did we say? That people who are wealthy and elite are doing better than ever, and they have more disposable income, and they have more assets and more things that they need to manage, and they are much less price sensitive. They care more about their time than they do necessarily the top line dollar amount of something. So I think that if I were to be starting a business today, I would be saying, what can I do that's servicing very wealthy people that I think are going to continue to be wealthy over the next 5 to 10 years, and are perhaps less price sensitive as we continue to see inflation stick around. That's sort of the number one thing that pops into my head.
Did you see that new airline, the luxury dog airline that they have for people on private jets? I think it's like $6,000 to bring your dog on a private jet with yourself?
I've heard about it, yes. But that's exactly it, right? It's about time and it's about convenience. And there is, for as much as everybody is struggling, there is a group of people that is doing incredibly well. There are these bubble economies throughout the country where you go there and you're like, wait, there's things aren't going well. Like, what's happening? And people are driving their Lamborghinis to the grocery store, and I mean, it's absolutely insane. And so, certainly, that is not the norm, but it is bringing up those averages we talked about, and those people have benefited greatly. There's been this huge transfer of wealth from Main Street to Wall Street. And something I've been talking about for years, but apparently the Fed finally came out and said that in a study. And so, yeah, so those people who are doing well have all kinds of needs. So go get some of their money.
Also in the Washington, D.C. metro area, as we have 5 out of the 10 highest average median family
Right.
incomes, it's a Cantillon effect. I mean, I just today, a couple hours ago, I saw a McLaren in the Starbucks parking lot. I've never seen that before.
Right. Right. And I've even, one of the most ridiculous things that I see out on the West Coast are things like, and apologies to any listener if you happen to have one of these, but it's like something like a Lamborghini SUV. And it's like, wait a second, do you want a sports car? Or do you want an SUV? Because if you're buying a Lamborghini SUV, you just want to show off. There's no other reason to purchase that combination, right? Like it's like those two sort of polar opposites in terms of the focus of the vehicle. So so it's hard. It's a hard pill to swallow. There are people who are doing well. You don't have to eat the rich. Just go and use them for your business and try to get some of their cash.
Yeah, and I mean the rich can move to another country. I mean, France tried to put a 70% wealth tax, and people just left France. I mean, that was like 6 or 7 years ago, something like that.
Yeah, there were I think 9 or 10 out of the 12 wealth taxes that happened in Europe were repealed because they were such utter failures. And I actually saw there was an interesting article in the Wall Street Journal a week or two ago about India, which has like 80% of their taxes are paid by the top 3% of people, and they keep trying to go more after them. And they've seen at least 30,000 millionaires leave India because of this. So this happens all the time. Capital is mobile, and those people have the resources to move that around. So be mad at the policies. Let's try and get the policies changed. And in the meantime, try to grab as much for yourself as you can.
And Carol has the books to help you beat stagflation tax law. Again, if you want to be an entrepreneur, start with Carol's first book and second book, which is the second book is The War on Small Business, and her most recent book is You Will Own Nothing. All of them are available on Amazon or on Carol's website. I think they're all 3 on on Audible audiobook as well, right?
Yeah, so I have a narrator who Chris Coffey's done the last 2, and somebody else did the first one. They wouldn't let me do it, and it wasn't because it's such a pain in the butt to read a whole book. I wasn't going to put up a fight over that, but I did make them pick a man so people would know it isn't me. And Jason, if I can add too, I also have a free newsletter that people can sign up for that talks about some economic issues as well as some fun stuff, and that's at carolroth.com/news.